Hi, this is Daniel with Unrivaled Investing. Today we're going to be talking about the hot stock GrowGeneration. The ticker is GRWG. Why did it get my interest? The reason why is the stock was up about 500% from the March lows earlier this year, 2020. And also FinTwit was in a tizzy. So I'm curious to make my own call. A lot of people like to look at companies on a technical basis. Honestly, I think a lot of that's garbage. My personal approach is let's look at the fundamentals of the business. What are the fundamental drivers that's going to be driving this business in the future? And is there real potential? Is there stake to this sizzle that's worth digging into? So, but if you're interested in finding, companies that can potentially go up hundreds of percent or already have, and maybe it's just the start of their run, hit subscribe to that channel, this channel, Unrivaled Investing, or you can go to unrivaledinvesting.com where you can subscribe to see what I'm buying or selling in any given month. So that way you can see, oh, this is what I own in my portfolio. This is what I find interesting. Why do I find it interesting? And as always, if you have any questions or want to comment about the stock, the company, the situation, feel free to post it in this YouTube channel. And also digging into what they do. Before that, a little disclaimer that earlier I was buying the stock actually, so I do have some skin in the game. Where you can see that I was buying it around $19 a share. So let's dig in, and it was about $2,000. So it's a teaser position for me where I'm starting to size up the company and the position. So what's the goal of this video? It's an introduction into GrowGeneration. What do they do? What's their market potential? Do they have an unrivaled value proposition? Regular viewers know I view every investment through the lens of an unrivaled value proposition, or a UVP. The reason why it's important is because you can't grow long-term sustainably unless you have an unrivaled value proposition. A rising tide lifts all boats, but you want to be in a situation where you're just constantly crushing it no matter what the market's doing. And so that's why sizing up, do you offer something, a good or a service that no one else offers? That becomes super important to sort of sizing up. Does this company actually have growth legs, not months, but potentially years or even decades into the future? And then lastly, thoughts on the valuation, the risk reward. Does this have 10x potential from here? It's obviously up a lot already. Is this just speculative froth, or is there actually something to it? So let's dig in. So what actually does GrowGeneration do? GrowGeneration is an omni-channel national hydroponic supplier to the cannabis industry. So yeah, a lot of people are gonna be like, oh my gosh, a pot stock. Is he really talking about a pot stock? And honestly, this is my first pot stock. So this is a little virgin territory for me. I'm a fundamental investor. I don't buy on sizzle. I buy on stake. And so this is, if this is interesting, and I think that there's merit to the companies, I always dig further. And so here, what's interesting is they're a retailer with solutions tailored to the pot industry. And for those that don't know what hydroponics is, it's a method of growing plants using mineral solutions in a water solvent versus having soil. The way that that's advantageous is that you can do it inside. You don't necessarily have to have a lot of real estate outside to make it happen. So you can, let's say, be in a city and easily develop it inside your apartment complex or something like that. So what exactly are they selling? I mean, they're not really selling the pot. They're selling the hydroponics that's primarily used for the cannabis industry. So you can see the detail here: nutrients and additives, growing media, plant health and safety, containers, all these different things. Lighting's a big thing. And the part that's interesting here about this is you always want to size up businesses that have recurring revenue. Because if you don't have recurring revenue, there's always a lumpy aspect where you get worried that, hey, there might just be a flood of new customers and it's a one-time purchase and then you're done. And so management estimates 60% of sales are consumable or repeat products, which, looking at this chart makes about sense. I mean, you could look at a few of these things and say, like, yeah, like I can easily pencil out, 60%. That makes sense. It also makes sense that a large portion is fixed, given that you have things like lighting or hydroponic systems that are probably like a one-time purchase. So that makes sense. It's not the figure that I'd like to see, and like if you look at a software company, it's, some software companies are like 99% recurring revenue. So it's not ideal, but it's good to know. They're penciling out 60%. So how are they selling? It's primarily through a store chain. They currently have about 28 stores. It's a specialty garden center, and they've been open throughout COVID. They're not huge. They're about 7,000 square feet on average, and they sell about 2 to 3,000 stock keeping units in the store. But if you go to their online presence, they have about 10,000 SKUs or stock keeping units. Their commercial sales, which we'll dig into a little bit more in the future in the coming slides, is about a little under 20% of their revenue based on management's guidance for 2020. Their online presence, management is penciling out mid to low single digits, but is growing quickly. And that leaves primarily their retail business that's driving the rest, which is people going in buying stuff they need so that they can grow pot for themselves. And this is sort of worth thinking about for a second. Well, like, why are so many people buying buying this stuff so they can grow pot for themselves? And I think there's a few things. One is you do have some sort of COVID bump where people are stuck at home and they're like, hey, what could be something fun to do? Two, pot is inherently expensive. You go to Mad Men or something like that and you're going to be paying up a lot. It's an expensive recreational substance. And there's also probably some fun aspects to it of like, hey, you grew your own inside your own home. And, like, hey, you can play around with different variances and try different strengths. So I think that it's a question of whether or not this is just a hobbyist thing or whether or not this could grow substantially. And that's their commentary on the commercial side is, those are folks spending a lot more money with them, and oftentimes they're in multiple different states. But we'll dig into that in a second. But now you have a broader understanding or an understanding of how are they doing most of their sales, which is in these types of stores. They aren't super large. This isn't like a Home Depot or something like that. But they do offer, a few thousand different units that are relevant to growing your own weed, the hydroponics for your weed. So what are their operating or growth strategies? And there you can see a little happy pot plant. Their operating strategies first to increase private label penetration. What's that mean? That means private label, first of all, is when you own the brand that you're selling, but it's a different label. So when you go into the store, you don't necessarily know that it's a GrowGeneration lab. They'll slap on a different company that they own. In this case, it's Sun Leaves, where they're trying to offer all these different products that you might need if you're going to be growing your own weed. So they're currently at about 2% private label. They're targeting 10%. I think it's within 12 months. It could be by 2021. Why is private label so important? It's because you have better margins. They think that their gross margins are about 50% with private label versus mid-20s for the consolidated business currently. So that's obviously a game changer if you're able to grow, your private label penetration from, let's say, 2% to 20%. Then your inherent operating margins go way up. So what else is sort of their operating strategies? But this is good for you to know, as this is a retail play. First of all, I don't have a lot of retail exposure in my portfolio, so this is adding to it. This is my first pot company, as I already mentioned. But private label is a good way to understand where margins could increase significantly in the future. So what are their other operating strategies? Also landing these new commercial accounts. We touched upon commercial a second ago about how it was a little under 20% of their guided revenue for 2020. And they're saying commercial is over $50,000 spend with the company. And why are they winning these commercial accounts? One is this omni-channel / SKU or stock keeping unit availability, where if you're a larger grower, you might have very specific demands, like you want this very specific type of lighting or this very specific type of nutrients. And that would strike me as something where you want to go to the brand that's associated with this niche. And that's why I actually really like that they plaster the GrowGeneration, where the pros go to grow. That's their slogan. it sort of reinforces like, oh, this is where we're supposed to go, and they're focused just exclusively on this niche, which is interesting. And so that would, like, as you create this brand, it further gets the interests of these commercial players that say, hey, we need this specific item, we're going to go to GrowGeneration. They're also winning, so they're winning not only because they have this retail presence that they're growing, but because they have this much wider selection online as well that you can select from. They do have a dedicated sales force that's targeting, calling up, trying to get these new clients, and it seems like they're winning. They said that they gained 167 new clients in the second quarter of 2020, and now it's up to 700 clients. So that's pretty quick growth. And in the second quarter 2020, commercial sales were up 142% year over year. So this is a fast growing segment of the business. What else is going on? Organic growth. Same store sales were up 49% for the second period 2020 versus second quarter 2019. That's amazing that foot traffic was up during a pandemic. Like, people are saying like, oh yeah, I'll go in, like I'll mask up and I need to go get my hydroponics supplies for my weed that I'm growing. Like, that's just incredible to me. But what's also interesting is it's not just a COVID bump, because if you look at same store sales, which tracks stores that were open 12 months prior going through now, so you don't get that full benefit of new stores. It's what was open previously. So the same store sales were up 36% in 2019. So this is, you do see some acceleration in 2020, but it's not just this year. It's not purely a COVID bump. This also, sort of as a non sequitur, this should get you thinking like their growth is in part going to be affected by state legislation, states that open up, states that may pull back a bit. So there's definitely going to be some sensitivity to the legalization of marijuana throughout the US. So that's definitely something that's going to be driving, like, hey, these states just opened up. Yeah, you're going to see higher foot traffic or growth in their sales, because they're, it's a relatively new market. But if states start closing up for some reason, which I don't expect, then you would obviously impact same store sales. So they're targeting opening new stores. So you have this organic growth, but you also have this key component of mergers and acquisitions. Generally, what they're targeting is these small, undermanaged retail stores where they're paying 2 to 3 times EBITDA, which, as any private equity investor would know, is mouth-wateringly attractive. I mean, that's super duper low. But it's also because it's this one-off store. Maybe it's a small chain of a few stores. And it's generally undermanaged. It's a very local market. But when you're paying 2 to 3 times EBITDA, that means there's not a lot of other buyers for this. There's generally a quick payback. Part of the reason why they might have low multiples is also because they might have, potential buyers might have a problem getting financing to, buy it up. Oftentimes there's sort of limits on, or there might be, if you're a lending institution, you might have policies in place to say like, oh no, we don't provide financing for guns or strip clubs or pot or any of these fields. And so that might also be contributing to the low multiples. I'm just sort of saying the unsavory aspects of society sort of influences financing. So this might be part of it. But if that's the case, it does create a little bit more of an opportunity for them to be buying these things at low multiples. And you can see that here, where they're saying because they're buying it at this low multiple, EBITDA is a way of measuring cash. It's obviously not perfect, but it does sort of track it, and it's before any sort of capital expenditures like building out a new store. But because the multiple is so low, the payback is about 2 to 3 years. Based on buying these one-off stores, which is really quick payback. I mean, if you think about it, if you can make an investment today where you get your money back, 100% of your money back within 2 to 3 years, and then you get all the cash flow of that money going forward, yeah, I would be very interested. So the fact that that's what they're able to do seems interesting. They also, have a couple of things where they do an immediate investment in these, one-offs that they're acquiring, where they're improving the SKU, the branding, and the planogram. The reason why this is important is they're saying, based on the stores that we currently have in our chain, we can tell that this is the layout that would be much better. It's currently undermanaged. If it's a one-off store, they don't really know what's best for them. And so by doing this, having a brand, having this is the way to lay it out, let's enhance the stock keeping units, it has resulted in increased traffic. Another item, that's super interesting is they've said that when they've acquired these one-off stores, it's resulted in increasing margins by 5 to 7% because of purchasing power. Now, any investor, or any aspiring investor should, whenever you hear something like that, like ding, like, whoa, what's going on here? The reason why this is interesting is if you can buy a smaller player and get a 5 to 7% improvement. Now, keep in mind, their margins are already, operating margins are already around 6%. So if you're able to get a 5 to 7% improvement because you have scale and you can get better discounts from your suppliers, that can be a special advantage for your business. It's effectively scale. If you have a cost advantage, therefore you could have lower prices than your much smaller competitors. So this is that both of these items, like, hey, best practices and purchasing power, is starting to strike me as interesting. We'll get more into that in a minute. So is there an opportunity to roll this out nationwide? So the M&A landscape, they say there are over 1,000 hydroponic stores in the US. More and more states are legalizing, which, given that all these states are in huge deficits because of COVID, they'll need the tax revenue from the pot sales and the peripheral sales. So I don't see that trend reversing in the near future. And they're saying that the hydroponic market size is somewhere between 8 billion in 2019 growing to 16 billion. I mean, that's, who knows, it's several $billions. And given that they're guiding to about 170 million in revenue this year, that's just a little drop in a bucket and would reflect that there is a lot of potential. But let's ask, like, what about the competition? Well, first, back to the main point on the M&A is it's actually a super fragmented market. I mean, if you have 1,000 plus players, you literally have hundreds of competitors out there. But is there new competition? Is there someone stepping in? And this is from the second quarter, where an analyst said, just curious if you're seeing any new entrants from below or above on the competitive landscape. Management responded, we have not at all. We've seen zero. Okay, but competition can definitely change, and it's something I think any investor in this company should keep their eyes wide open about, looking at their quarterly results, because opening a new store, and this is something they've called out, only requires $700,000 in inventory. So $700,000 in inventory, throw on a couple of $100,000 for making the store nice and stuff like that, and getting best systems in place, that gets to about $1 million for opening a store. I'm just ballparking here. So, like, the barrier to entry to get what you need to sell the hydroponics equipment to the pot industry strikes me as fairly low. So if you think there's hundreds of competitors, low barriers to entry, is it even possible for them to have an unrivaled value proposition, which is the key to long-term growth? And it's quite possible. It's possibly in the future. One is if they get a scale advantage, because let's say they own 200, stores, and they've had this huge online presence, that's growing very quickly, and they become the brand associated with hobbyist pot growers or even commercial pot growers, and it stays a fragmented industry. So if you have that, they could get scale advantage from their suppliers because they're buying so much from their suppliers that, they do get some pricing benefits versus a mom and pop shop. The next question is, could they have some sort of best-in-class operating structure where they know, based on, let's say, dozens and dozens of stores, that this is the right layout, the planograms, to be showing a retail store. So they know this is the stuff you need to see right when you walk in the store. And you put the lights in the back of the store because that's where, so that way everyone walks by all this other stuff before they go. So there definitely are some elements that could create an unrivaled value proposition. And also, focusing on a niche can really be a wonderful thing. This is, some folks are like, hey, why isn't Home Depot or Lowe's just going to crush them? And it honestly reminded me a little bit of Sherwin-Williams or Benjamin Moore, which is a company that Berkshire Hathaway bought. These are paint companies. Sherwin-Williams is public, and they've done fine. The stock has done really well over time, where they focused on a very particular niche. And if you focus on a particular niche, you get an association with your customers where they want to go to you because they know you have the exact inventory that they need. They don't necessarily need what they have from Home Depot. Home Depot might not have the lighting or the nutrients that they can get from GrowGeneration. And so that's that aspect, that association with, hey, this is a store that almost exclusively focuses on the cannabis industry, helps reinforce this idea of like, hey, they're targeting this niche where they can win over time. So if these three components, a scale advantage, best in class operating structure, targeting this niche with limited competition, or limited competition from the sense that they dominate, if they're able to scale, get bigger and bigger over time, and that they're one of, they're the only big brand in the industry selling, and it's all these other mom and pops versus them, then it's possible that this company has an unrivaled value proposition. It's possible, but not guaranteed. So how has the company recently performed? And they're smoking. So sorry for the dead joke. I figured I had to throw that in there. But their 2020, their second quarter results, their revenue is up 120%. Their annualized revenue based on the second quarter is about 175 million. They're profitable at 6% operating margin. They're free cash flow positive year to date, and they have a net cash balance sheet where they recently did a $50 million secondary. So this is, a really interesting setup. What about the guidance? They're guiding to 170 to 175 million in revenue, which implies about 120% year-over-year growth and 10% plus EBITDA. They're also providing guidance for 2021 of 245 to 260 million in revenue, which is about 45% growth from 2020, and 10% plus EBITDA. So I wrote here just because I generally don't like seeing that guidance, and management has also talked about how their mission is just to be the biggest, hydroponic supplier to this industry, and that's what they're focusing on. I don't like, growth at all costs. I don't like that to be their pure focus, or that they're targeting, 2021, or at least they're articulating it. It sort of rubs me the wrong way. People can make their own assumptions, and honestly, I think most people are already discounting that as just a sort of a low ball, because going from 120 to 45 seems low, given that they're probably going to be able to buy or open a bunch more stores. But it's interesting. I mean, maybe it's a talking point that they're using for growth dynamics of like, hey, this is where the stock could be because this is the type of growth. I don't care to see it, but that's one aspect. So what are the current thoughts on valuation? And keep in mind, this is a hypothetical. There's some thoughts that I put together where you can see, currently it's around $900 million market cap. This is between $18, $19 a share. Their estimated sales. So this is low, base, high range. They're guiding to 100 to 175, 174 million annualized based on the second quarter. So you can see the implied growth rates. Then what let's say if you were to buy it today and hold for the next 5 years, let's call that your investment period. What's the growth rate that you want to underwrite? And once again, throwing 25 to 50%, going from, let's say 170 million this year to 500 million, or 3x to up to an 8x, so nearly 1.4 billion. And so, when you think like, hey, they said that this is going to be, let's say, about ballpark $10 billion industry, could they get 10% market share? Yeah. I mean, especially if they executing on the points that we talked about earlier, The assumed margins, currently they have about a 6.5% operating margin. I would think it would only get better from here, given, some of the, first of all, if you look at Home Depot, for example, Home Depot is in the mid-teens. So as a comp, okay, there's upside there. And then we also talked about private label, which, is 25% greater margins than the existing business. So if they're able to actually get some real private label penetration, you'd have this huge operating margin leverage there, where if people say, hey, we want to buy the GrowGeneration private brands because they're cheaper or something like that, there's definitely margin potential there. So that's why I put a fairly wide range of 7 to 15%. Also slapped on a tax rate, of 25%. That could go higher, if depending on the presidential candidate. And then, so next you can see how earnings really is, the net earnings goes from a low of $27 to a high of 150 million. And that's just based on like what's the underlying growth rate, what's the underlying operating margin assumption. And then also let's put a wide range of multiples. 5 years out, are they still growing really fast, or should this be valued more like a traditional retailer, and get 15 times on the low side versus 25 times where it's a growth story? So based on this range, you're getting 50% downside to 300% upside over the next 5 years. So about a 6-to-1 risk reward, which is interesting. It depends on how you want to pencil these things out, and that's why I'm trying to create an unrivaled value proposition for myself, for you, by creating these Google Sheets that you can go to. There's a link in the description of this video where you can play around with the assumptions yourself. So if you think the high side's way better, or you think high side, getting high, if you think the high side is better, then you can play around with that. And if you think the low side, should be a lot higher, then you can play around with that as well. So that's my value proposition to you, is that I'm going to not only do these videos, but occasionally drop these sheets for you to play around with yourself for your own investment purposes. For the do-it-yourself investors that want inspiration for their own financial journey, want to see what I'm personally buying or selling in any given month, you can see how I analyze companies in these videos, but you don't know if maybe I sour on GrowGeneration a few months from now, or I think, wow, there's a bigger opportunity here, and I start scaling up significantly. It's no longer a teaser position. That's what my subscribers at Unrivaled Investing get to find out, and that's a monthly update of what am I doing in my portfolio and why, with a thought on valuation and what the company offers. So feel free to go to unrivaledinvesting.com, click on that journey button. And if you enjoyed this video, please subscribe, and thank you so much for watching.